What if the next US recession has already quietly started, but most investors still don't see it? Right now, several warning signals are beginning to appear across the American economy. Consumer debt is rising, commercial real estate is under pressure, market valuations remain historically elevated, and recession indicators like the inverted yield curve continue flashing warnings. At the same time, artificial intelligence optimism is still pushing markets higher. So the big question is America heading toward a recession? Or will AI and liquidity keep the economy stronger for longer? In this presentation, we'll break down some of the biggest economic warning signs investors are watching right now. And before we continue, if you haven't watched our videos on uranium, silver, copper, global trade choke points, and the stock market bubble yet, make sure to check them out because many of these trends are deeply connected. Also, don't forget to subscribe, activate the notification bell, and leave a like because it really helps support the channel. And one important note, some charts and figures in this presentation are simplified or rounded for educational purposes, so real-time values may slightly change over time. One of the most famous recession indicators in financial history is the inverted yield curve. Normally, long-term government bonds offer higher yields than short-term bonds. But when short-term yields rise above long-term yields, investors begin to worry about future economic growth. Historically, many major U.S. recessions were preceded by an inverted yield curve. That's why economists continue watching this indicator very closely. The exact spread values shown on screen may vary slightly depending on market conditions and data timing, but the broader trend remains important. Another growing concern is the condition of the American consumer. Credit card debt has reached historically high levels. At the same time, higher interest rates are making borrowing more expensive for households. Many families are now paying significantly more interest just to maintain normal spending. Savings levels have also declined compared to the years following the pandemic stimulus period. Because consumer spending drives a large portion of the U.S. economy, weaker consumers can eventually slow economic growth. Commercial real estate is another sector facing pressure. Office buildings across major U.S. cities continue struggling after the rise of remote work. At the same time, refinancing debt has become much more expensive because of higher interest rates. Some analysts believe parts of the commercial real estate market could face significant stress over the next few years. Banks also maintain meaningful exposure to commercial real estate loans, which increases financial system sensitivity if conditions worsen. Despite economic concerns, the stock market remains near historically expensive valuation levels. Indicators such as the Shiller CAPE ratio continue to suggest elevated valuations compared to historical averages. At the same time, market concentration has increased significantly, with a small number of large technology companies driving a major portion of market performance. Supporters of the market argue that AI innovation justifies higher valuations. Critics believe markets may be pricing in too much optimism. However, there is another side to the story. Artificial intelligence investment remains extremely strong. Technology companies continue investing billions of dollars into data centers, chips, cloud infrastructure, and energy systems. Many analysts believe AI could improve productivity and support long-term economic growth. Others worry that excessive optimism could eventually create another speculative bubble. Beyond the U.S. economy, Global risks also remain elevated. Geopolitical tensions, trade fragmentation, energy disruptions, and policy uncertainty continue to affect financial markets worldwide. Conflicts involving major global powers can impact supply chains, inflation, shipping costs, and investor confidence. That's why many investors are now paying closer attention to geopolitics than they did in previous decades. So, what could happen next? Markets are currently debating between several possible scenarios: a soft landing, a slower growth environment, or a future recession. The reality is that nobody knows exactly what will happen next. Economic forecasts constantly change as inflation, interest rates, employment data, and geopolitical events evolve. So, what can investors learn from all of this? First, markets today remain filled with both opportunity and risk. Second, diversification and risk management continue to matter more than prediction. And third, long-term investing usually rewards patience, discipline, and emotional control. Economic cycles always change. Market narratives always evolve. And uncertainty is a permanent part of investing. If you enjoyed this presentation, don't forget to like the video, subscribe to the channel, activate the notification bell, and let me know in the comments what topic you want us to cover next. And remember, this content is for educational and informational purposes only and should not be considered financial advice.